After the shocker that was the Australian 2026 federal budget, many Aussie investors, particularly those who are open to perhaps moving overseas, are assessing their options. And one of the countries that has come up as an alternative is New Zealand, when Australians are going to be paying minimum 30% on capital gains, on property, on shares, on crypto. Somewhere like New Zealand that does not have a formal capital gains tax starts to look pretty attractive. So let's learn a little bit more about the New Zealand capital gains tax system and whether or not taking a trip across the Tasman may be a viable option for you. Before we get into the nuts and bolts of the capital gains tax in New Zealand, I'll just say that if you are looking to capitalize, to utilize the lower tax or the no tax on capital gains in New Zealand, you're generally going to have to leave Australia, cease residency in Australia and establish tax residency in New Zealand. Now, if you're interested in doing that, that is what we do here at our firm. Head over to quintrell.com.au. There's a link in the description and we can help you to make your move over to New Zealand and exit Australia tax efficiently. All right, so let's get into the capital gains tax policy for New Zealand. So they do not have a formal capital gains tax, but they do tax capital in certain scenarios. And rather than having a formal capital gains tax policy like Australia does, when New Zealand does tax capital, they'll just tax it as regular income. So when it comes to property, they have what they call a bright line test. And this is all about if you hold the property for 2 years or longer, there is no tax on the gain of the sale. There has been a bit of movement around this as different governments have come and go. It was introduced, the bright line test was introduced back in 2015 and it was set at 2 years at that point, as it is today. In 2018, 2 years was bumped up to 5 years. So at that point you had to hold the property for 5 years if you wanted to avoid tax on the sale. Then in 2021, it was bumped up to 10 years. This was for existing properties. Now, currently, after the current government got back in, that's been moved back down to 2 years. So hold your property for 2 years, you can sell it tax-free. Sell it within 2 years, you're going to pay tax on it. Similar to Australia, your primary residence or your principal place of residence, whatever you like to call it, the home you live in, is generally tax-free. And when it comes to people who are in more of a property buying and selling business, think of this like a flipper. If you buy for the purpose of selling, they have a rule where if you have an intent to sell, like a property flipping business, this would be regarded as a profit-making scheme. And Australia actually has similar rules to this as well, even before the budget. Whereas if you were in a profit-making scheme of property, that can be treated as regular income when you sell it rather than a capital gain. Now, when it comes to shares, New Zealand doesn't have a strict 12-month holding policy like Australia does, if you want to get the discount in Australia, that is. Their version of that is if you are a buy and hold investor, so you're not, trading short-term stocks, you're buying something and you're probably holding it for a number of years in order to get capital growth or to earn dividend income. Now, when you do sell this parcel of shares, that can be tax-free in New Zealand, provided the shares that the company that you invested in is a New Zealand company. It's going to be tax-free if it's buy and hold. And also this tax-free exemption applies to most Australian shares as well. So if you're a New Zealander and you own shares in BHP and it's buy and hold, that can be tax-free. But if you're a short-term trader or if you're selling just, holding for a couple of months and selling, moving in and out of buy and sell positions, that will likely be taxable in New Zealand. So buy and hold is the way to go if you want to reduce your capital gains potentially down to zero. Now let's talk a little bit about foreign holdings. We said just now that buy and hold investments can be tax-free for New Zealand shares and Australian shares, but New Zealand is a pretty small place. So for a lot of people who are investing in New Zealand, they're going to be looking for the broader market, whether it's Europe, the US, Asia, and so on. So when a New Zealand tax resident sells foreign shares, we're not talking about Australian shares, let's say it's US shares, they are taxed differently. So if the balance is under 50,000 New Zealand dollars, that can be tax-free. If the balance is over 50,000 New Zealand dollars, What they do is they place a deemed rate of return on top of this investment, over the top of the investment. They say, okay, we think the investment of over $50,000 is going to be have a deemed return of 5%, and they'll tax you on that 5% like it is regular income. So still not too bad. And when we're talking about this $50,000 threshold here, that is the cost base of your shares that we're talking about. So if it's below 50,000, it can be tax-free. Now, of course, some of you will be interested in crypto. Well, crypto taxation in New Zealand is still an evolving space, even though crypto has been around for some time now. But generally speaking, crypto gains in New Zealand will be taxable if your purpose of holding those coins is to sell or exchange them. So yeah, that is pretty vague. You'd probably want to get a bit more advice on that if you're looking to move to New Zealand and hold crypto. But what it sounds like to me as an Australian accountant is that if you are sort of holding onto them, you're not looking to sell, you're not looking to exchange, maybe you're even using it for money. Potentially this could be tax-free, but that is something I would get advice on if I was you and you were moving to New Zealand. Now, what is the general outlook for capital gains tax in New Zealand? Well, the current government has no plans to change it, but all it takes is a change of government and everything could change. It has done in the past. But still, most of the changes in the past have been around this bright line test, which is still a lot better than what is available to investors in Australia. And again, guys, it is worth mentioning that if you want to utilize this low tax structure in New Zealand, it's not going to work if you get on a plane, or not even get on a plane, just open up a share brokerage in New Zealand, or buy some property in New Zealand and still come back and live and be a tax resident in Australia. You have to be prepared to cease residency in Australia and establish tax residency in New Zealand. So if you want help with that, making an exit in Australia and establishing yourself in New Zealand, get in touch with us over at quintroll.com.au, link in the description. Thank you for watching. Catch you later.